Charlie Munger recently said investing in Alibaba was one of his worst investment mistakes. Looking at the company's stock price in the last month or so, the stock price is down by 24%, signaling that the market agrees with 99-year-old Munger. Is he right about Alibaba? And if not, what are some of the reasons Munger and the stock market are wrong about the company? Let's talk about them. My name is Hoda Mer, founder and CEO of StockCard, and I own 99 shares of Alibaba, which I paid an average of $134 per share for them, sitting on $4,500 in losses on the day of recording this video. Like all good investors, I hate losing money, but more than that, I hate being wrong about a company. When Munger said Baba was his worst mistake, I was upset about my investment decisions. But what if Munger is wrong? Should I hold on or even add more shares? Today, I'll explain why Munger is wrong about Alibaba and tell you my plan for my 99 Baba shares. If you own Alibaba shares or are considering buying the dip, this episode is the one you don't want to miss. Don't forget to use this video as an educational resource, not investment advice. I'm not your financial advisor. In his annual daily journal shareholders meeting, Munger said his mistake was assuming that Alibaba has an important position in the Chinese internet industry. He forgot that the company is a retailer at its core. Looking at Alibaba's latest quarterly earnings report, 77% of the company's revenue comes from local China or international commerce combined, while cloud and other non-retail operations such as media business represent the rest of the company's revenue. So based on revenue, Alibaba is a retailer. Munger is correct. Even based on earnings, Alibaba is a retailer too. While the cloud segment generated $52 million in adjusted earnings before tax, interest, and amortization, that's less than 1% of the consolidated adjusted EBITDA for the entire company. It also only grew by 3% in the latest quarter, which gives us a sense that this segment still isn't a critical growth driver for Alibaba. An interesting comparison with Amazon better highlights this fact. While more than 84% of Amazon's revenue comes from its retail operations, the cloud segment, known as AWS, is the segment that brings $23 billion in operating income to the company. Unlike Alibaba, whose top and bottom line comes from its retail operations, Amazon is a cloud business, judging by its bottom line. Also, let's not forget that Alibaba is aggressively investing in its cloud segment, which may lead to significant growth in the future. From the latest earnings report, we know cloud is a core focus area for Baba. However, so far, Munger is right. Alibaba is an online retailer at its core. But the story turns around from here. Is being an e-commerce player a bad thing? Isn't there any growth potential left in Alibaba's operations? China's e-commerce is expected to grow by 12.4% annually between 2023 and 2027. This means if Alibaba grows in sync with the overall market, and since most of its revenue comes from retail operations, it can boost its annual revenue growth higher than the current 2% year-over-year growth. This is very likely, especially as COVID restrictions are cut back and the Chinese economy should go back to growth soon. Therefore, there is potential to grow the business due to the expected growth in the overall market. This immediately makes me wonder whether investors see such growth opportunity for Alibaba and how company is being valued. Let's dig into Baba's valuation now. At around $230 billion market cap, investors price the company less than 2 times its sales. In other words, investors believe Alibaba can double its revenue from where we stand today. Assuming that the company can grow as fast as the overall e-commerce industry in China, then at 12% annual growth, In 6 years, it can double its revenue. We shouldn't ignore that Alibaba is a dominant player in Chinese e-commerce market, and while the market can grow by 12%, the company may not be able to grow as fast as the overall market due to the growing competition from smaller players in the market. But even with that consideration, the revenue should be able to grow faster than the recent 2% year-over-year growth. This means using price to sales valuation methodology, the stock is fairly priced. This brings me to the next point in my research. Is there a way for Alibaba to grow its profitability? After all, over the long term, the company's earnings power play a critical role in its stock price movement. This is where we need to dig into the P&L more than just looking at the surface. Alibaba has a nearly 40% gross profit margin. It is lower than most other technology companies, but it is way better than other e-commerce companies such as Amazon with a 13% gross margin and Wayfair with a 28% gross margin. This is an interesting realization. Although Alibaba is not growing rapidly, it has much more profitable operations. And its profitability doesn't stop at gross margin. Alibaba generates free cash flow. In fact, the quarter ending December 2022, the company generated nearly $12 billion in free cash flow, 30% of its $36 billion quarterly revenue. It also holds a significant amount of cash and equivalents, about $50 billion on its balance sheet, and has a debt-to-equity ratio of less than 0.5. In other words, Alibaba boasts a solid balance sheet. Let's summarize what we have learned about Alibaba so far. The company is mostly an online retailer and doesn't yet have a strong presence in cloud similar to Amazon. The e-commerce industry is growing organically in China, and Alibaba should grow steadily with the market. The company's stock price is reasonably priced and can easily grow in its current valuation. It runs operations more efficiently than its e-commerce peers such as Amazon or Wayfair. It generates a healthy free cash flow, and it boasts a strong balance sheet with limited liabilities compared to its cash holdings. Returning to Charlie Munger's disappointment about Alibaba and his investment in Alibaba, he's correct that it is a retailer at its core, but even if it is not going to grow as rapidly as tech platforms, Alibaba is still a solid company and a long-term hold. While I greatly respect and admire Charlie Munger, he hasted into buying Alibaba with wrong expectations, in my point of view. But yet again, I respect him for realizing his mistake and getting out of the position when he realized the company wouldn't meet his expectations. For the rest of us, we don't have to follow Munger. So what do we do with our Alibaba shares if you own shares like me? Alibaba's stock price will go up assuming the e-commerce industry grows as expected and the political challenges internally and internationally do not interfere. You may heard about the Chinese government's $2.8 billion fine for Alibaba as a part of a national crackdown on anti-monopoly efforts in 2021. That's an example of a risk associated with owning international stocks, which may disrupt all our assumptions and research today. Aside from that, I have 3 options for my 99 Baba shares. Firstly, I can sell them now, take $5,000 in losses, and invest the rest of the capital in a company that can grow faster than Alibaba. The advantage of this option is that I can use the $5,000 loss to offset some of my other capital gains and avoid paying capital gain taxes. By the way, if you want to learn how to avoid paying capital gain taxes legally, I recently published a video on the topic that I will link to it in the show notes. But back to my options to deal with my Alibaba stocks. If I plan to sell the shares, and free my capital, I can do so while generating some income from my shares while I wait for a reasonable price to sell and even protect myself from further losses. Since I already own 99 shares, I can buy one more to get to the 100 shares to be able to sell a covered call options on my 100 shares, collecting some premium, and then let the shares get called away from my account when the price goes up eventually, which is what I think will happen. Or lastly, I would hold on to my shares and be patient with the company as long-term hold due to all the reasons we discussed today. What would you do with your shares if you own them? Or what would be your strategy if you were in my shoes? Share your ideas in the comments to learn from each other. In the meantime, I'll reflect on my 3 options that we discussed today and update my role with our CEO portfolio when I conclude. If you want to get notified of my final decision in the next few weeks, follow my portfolio on a StockCard platform. It's free to follow. The link is in the show notes, as are the links to a few interesting resources and next videos to watch. Head down to the show notes and I'll see you next time.